What if I told you that picking the wrong fund or following the wrong advisor can cost you more than a bad stock pick, and you might never notice? In this video, we'll cut through the marketing fluff around mutual funds, ETFs, and financial advisors, and give you simple rules to protect your returns and avoid common traps. The goal? Keep more of your money compounding for you, not for middlemen. Chapters 9 and 10 are extremely practical. Chapter 9 is all about investment funds, what they are, where value hides, and where costs hide, and which kinds of funds make sense for defensive and enterprising investors. Chapter 10 turns to advisors, how to choose them, what conflicts to expect, and how to make sure you're getting honest, competent help. These chapters aim to save you money, time, and a lot of regret. Graham's core message about funds is simple. Funds are tools. Some are well-made and useful, others are expensive or misaligned with investors' interests. Know the tool before you buy it. He warns that the average mutual fund investor often pays much of their return away in expenses, turnover, and misguided marketing. And that was true then, and still matters now. Graham walks through the main fund types, the language updated for today. Open-end mutual funds, continually issue and redeem shares. Price, Josh, NAV. Good for regular investors, but watch fees and load structures. Closed-end funds, fixed shares trading on an exchange, often trade at premiums or discounts to NAV and can be mispriced. They may offer special opportunities for enterprising buyers. Index funds, passive funds, low cost, broad exposure. Though Graham didn't write with modern index ETFs in mind, his emphasis on low cost and diversification makes index funds an excellent match for defensive investors. Bond funds and specialty funds, useful for specific goals, but carry interest rate, credit, and liquidity risks you must understand. Graham repeatedly cautions, fees erode returns. High management fees, sales loads, and frequent trading, turnover, can turn a decent gross return into a poor net return for investors. For a defensive investor, low cost is not just a nicety, it's central to performance. Always check expense ratios and the fund's historical turnover before committing. Graham recognized that professional managers can add value, but also warned that competition and fees often erase that value. Today, a sensible takeaway is, if you don't have an edge or the time to assess a manager's skill and fees critically, lean passive or low-cost active. For the defensive investor, a low-cost broad index fund is usually the cleanest option. For the enterprising investor, selective active or closed-end funds, if mispriced, might be worth the extra work. Graham warns that folks selling funds often benefit from complexity. Multiple share classes, front-end loads, deferred loads, 12b-1 fees, redemption fees, and opaque performance reporting. Complexity can disguise costs and conflicts of interest. Read the prospectus, yes really, and prefer funds whose economics are simple and transparent. Closed-end funds sometimes trade at big discounts to NAV. Graham saw occasions where intelligent investors could buy shares of funds, or shares of mispriced funds, and earn above-average returns. This requires research, check asset values, distribution policies, and reasons for the discount, and is more for the enterprising investor than the defensive one. A simple Graham-inspired checklist for funds. Know the objective. Make sure the fund's stated goal matches your goal. Growth, income, preservation. Minimize costs. Prefer low expense ratios, no loads, and low turnover. Understand liquidity and structure. Open-end versus closed-end matters. Closed-end discounts can be opportunities or traps. Check the manager's record and style consistency. Past success under similar conditions and a consistent process matter. For defensive investors, prefer broad, low-cost index or balanced funds. For enterprising, use special situations or mispriced closed-end funds sparingly and with a margin of safety. Graham's view is blunt. Advisors can be helpful, but they're also a potential source of bias, churn, and bad incentives. The key is to know what advisor you need, understand how they're paid, and to demand clear standards of competence and honesty. Advisors come in many forms: brokerage salespeople, mutual fund salesmen, fee-based planners, registered investment advisors, RIAs, and robo-advisors. Graham warned that salesmen with commissions have incentives to sell products that benefit them more than you. Look for advisors whose compensation aligns with your success. Fee-only advisors, or those paid as a percentage of assets under management, are less likely to push churning products. When interviewing an advisor, Graham's spirit suggests asking, "What exactly do you do for me?" Be specific. How are you paid? Upfront commissions? 12b1 fees? Asset-based fees? Can you show a written track record or references? Will you sign a written agreement spelling responsibilities and costs? Do you have a fiduciary duty to act in my best interest? Graham reminds investors to be their own first line of defense. Even the best advisors are human and make mistakes. The investor should understand the basics so they can evaluate advice. A clear sign of a good advisor is someone who educates you and explains downside risks, not just the upside. Many advisors sell confidence in forecasts. Graham cautioned against advisors who promise market timing or guaranteed returns. Those are red flags. Prefer advisors who emphasize process, diversification, and long-term discipline. Avoid those who base recommendations on hype, complicated products you don't understand, or one-size-fits-all hot strategies. Follow these Graham-inspired rules when working with advisors. Prefer fee-only or transparent fee arrangements. Know your total cost. Get everything in writing. Investment policy, fees, reporting frequency. Ask for a clear, simple plan. If the advisor can't explain why they recommend something in plain language, walk away. Audit results periodically. Don't assume competence. Verify performance net of fees and compare to simple benchmarks. 4 concrete actions you can take after watching this video. Choose low-cost funds for your core holdings. Fees compound against you. Minimize them. Use fund structure to your advantage. Closed-end funds can be mispriced opportunities for enterprising investors. Open-end index funds are usually best for defensive investors. Vet advisors for incentives and competence. Prefer transparent, written agreements and fee structures aligned with your interests. Be your own first reviewer. Even with an advisor, understand the basics so you can spot nonsense and protect your capital. Which costs hurt you the most? Management fees, hidden fund loads, or advisor commissions? Share a story, anonymized, or a question in the comments, and I'll reply with a practical next step. Want a one-page checklist of fund metrics and advisor interview questions? Type checklist below. If this helped, like and subscribe for more clear, practical guides from classic investing wisdom. In the next video, we'll build a defensively priced portfolio using fund picks and advisor rules from these chapters. Plus, I'll share a downloadable checklist you can use to interview any advisor. Say checklist in the comments if you want that now.